Daniel LeBeau. Welcome back to the Fourth Revolution, where we discuss stocks for your portfolio of the future. We have one of those future stocks IPOing today. Robinhood hit the exchange with an offer price of 38, which was at the lower end of its guided range, valuing the company at roughly $32 billion. And the stock traded lower pretty much immediately out of the gates. They struggled. They struggled to find buyers in this seemingly red hot market as all of the major indexes hit all-time highs. Robinhood, a seemingly speculative name, is struggling to find demand for its shares, and it's justifiably so. The stock is currently trading at, with this $32 billion valuation, a price to trailing sales of over 20 times, which is absolutely ridiculous for a brokerage firm. When comparing it to Charles Schwab and Interactive Brokers, the stock isn't even close to reasonable. I mean, Charles Schwab, they were trading at, 8 times price to sales, while Interactive Brokers is only 2 times price to sales. So, 23 times is excessive for a company, even though they've had great growth. That growth that we saw during the pandemic is not going to be able to be repeated in this in the coming years, and you can't price that into the stock quite yet. Yeah, they did benefit tremendously from this new wave of retail investors swarming into the markets, but that doesn't mean that there's going to be an endless number of new accounts coming in. But nonetheless, the stock is trading, and it is dropping fast as the risk appetite for these IPOs is seemingly wiped off the table as this bull market matures. So let's take a look at the charts and take a look at what to watch for with this fresh IPO. This is Robinhood trading under the ticker HOOD, H-O-O-D, on the trading view charts. And this is the first 15 minutes or so of trading. Each of these candlesticks represent 1 minute. And you can see we've done nothing but drop since this IPO, and justifiably so. I mean, Robinhood hasn't done anything that revolutionary that it should be trading at 23 times price to sales, especially when its competitors are significantly lower and have a better growth outlook, in my opinion. I mean, I think Robinhood is going to see decelerating top line revenue, if not reversing this growth. And it's because this payment for order flow process, which makes up 75% of its top line, is not going to see the same expansions and huge volumes that we saw in the first half of 2021, which drove this retail cohort into the markets and drove enormous volume that was able to push this company's growth into the triple-digit percentages. So let's take a look at its S1 for some more details. This is Robinhood's S1, their initial filing with SEC. And you can see their net cumulative accounts here has just absolutely exploded. It's been even more prolific, even more accelerated during the pandemic. And it's because these millennials and Gen Zs are seeing opportunity in the market like they've never before. And a lot of it's being driven by Wall Street Bets, which is a message board where these millennials and Gen Zs can get together, talk about stocks, and actually target stocks together and move markets. And we've seen that with GameStop, AMC, and a number of other Reddit-driven stocks, and a lot of them called meme stocks. But this has just been prolific, the number of accounts that have been opened, and that free stock that they give you is actually a real incentive to open one of these accounts. So Vlad Tenev, the CEO of the company, came on to CNBC this morning and said that there was 22 million accounts now open with Robinhood, which even further shows the acceleration. That's just 1 quarter, 4 million new accounts. And it's crazy. You can see the volumes here with monthly active users and revenues just exploding during the pandemic as people are sitting at home and getting bored. And they're realizing that Robinhood is kind of a fun way to not only learn about the markets, but make some money potentially. And a lot of them got a little bit risky. You can see the level of options just exploding, and that is their highest margin product. That's what's giving them it made up 38% of the top line. Cryptos made up 20%, and as the market's volatility normalizes, those are not going to stay at that level. People are going to not be buying as many options, especially when the Reddit Wall Street Bets mania slows down and they run out of targets. Like these levels are not sustainable, and valuing a company off of growth that is just periodic is not going to be a long-term value creator for these shareholders. I'm staying away from Robinhood's newly issued shares. Its long-term revenue visibility is just not there. I have no idea where this company is going to be in 5 years. And yeah, they could pivot, but they haven't pivoted yet to other, fintech type industries. And that's kind of what they're pricing in right now. They're pricing in that Robinhood is going to be this next, fintech company like Square or PayPal, but it's just a brokerage account at this point. And I don't think it's being valued appropriately based off of that fact. So stay away from these shares for now. Could be opportunity in the future if this company does pivot and add different verticals to their top line. But with 75% of their revenue coming from payment for order flow, I don't like this stock at 23 times price of sales. But thanks for watching, guys. Don't forget to check out Zacks.com/promo, where we have 5 stocks set to double. So again, check that out at Zacks.com/promo. Thanks, guys.